Hey everybody, this is Paul doing a quick video here. Today is December 15th, 10:30 a.m. Central Time, and the market is currently open as you can see. So, I guess let's go over some things that happened in the last 15 days or so. So, first thing, CPI for November came out. As you can see, came in at 7.1%. Um, Different factors led to this. The one factor that was slightly a surprise to me was a big surprise to a lot of people actually, was OER, owner's equivalent rent, is still going up. As you can see here, the belief is this is still a lagged number. Um, it's very, it's hard to explain how they even get this number. It's more like a survey type thing. They'll call up different companies and different places that rent out apartments, I guess, and rent out houses, and I guess ask them what they think they could get for charging for rent. That doesn't seem very useful. So if you look at the Zillow and the Redfin data, that's more realistic data. The problem is that nobody can actually figure out what's the delay between the two. So the Zillow and the Redfin data look like, I believe, I thought I had that one on here, but it's just going down compared to what we see here where it's still going up. So that's where the market is having one. That's where the CPI report is just not doing exactly what people are expecting it to do. But it still came in much lower than expected. So what does that actually mean for the inflation rate? So it came in zero point 0.1 higher, which is actually very weak. Um, as you can see, what that translates into. So if we repeat December for the next 4 months, we hit the Fed's target. If we come in lower, which I expect, we hit the Fed's target much quicker. If we come in negative, which means we're going into a recession, which really looks like we're going into a recession, we hit the Fed's target extremely quick and then we blow through it. And then the story of next year is not inflation, but deflation. Because now you're having negative inflation, which means we got a problem. That's a bigger problem. This is very hard to solve because it took 9 months and 425 basis points, which is 4.25% increase in the 2 year, as you can see here. This started the year at 0.15, something like that. Very low, like 0.25. It's like right where they had it set, like 0.15, 0.25. And now we're almost 400, we're 4% higher. So that's pretty ridiculous. So it took 9 months just to start to get this turnaround. And when it starts to snowball, it snowballs in a very significant way. Just like it snowballs in a significant way. So this is what it looked like previously when you saw these zero point 0.6 in December of last year. You started to see this. It snowballs very quickly up. What happens here is it's going to go in the opposite direction now because there's a lot of things that are going to fall off the report that no longer apply. People on Twitter will try to tell you they're manipulating the data. It's just how it works. It goes by the most current data. It's 12-month sequence. So that's where we're kind of at. So the Federal Reserve did raise by 50 basis points. And then they talked about another 75 basis points. And you might think the market is actually reacting to that. But what the market is actually reacting to is more than likely a recession plus just normal end of the year type things like selling so that you can tax loss harvest. Um, because the other 75, the 0.75 that they talked about to get this up to 5.1% is obviously not priced into the market right now. I don't believe that's going to get priced into the market until it actually becomes a reality. I don't think the market believes the Fed, to be honest with you. So there's another meeting in February, and even in the most optimistic scenario, we'll be at 4.3%. So February could, and this is a big could, end up being the last hike. But if we have massive job losses between here and there. Maybe they slow down or something, or maybe they pause. But I have a feeling February might be the last hike that everybody's looking for. That's that magical pause. And then once we start to blow through their target, I think you start to get the cuts. So if you just get a repeat of December, we're hitting their target by June, and then we're blowing through their target and we're going lower. If we get anything weaker than December, which is entirely possible given how hard the economy is getting hit right now and all the data that's coming in, we blow through their target in a major way and we go negative. So they're going to be trying to cut to spur the economy, and it's just not going to work. By that point, it's just too late. So they've run out of time. Their only chance to stop a recession was probably this month. They could have just paused, waited until February, and then put 50 back on the table maybe, but the market would have reacted positively, obviously. But right now, it's recession is effectively priced into the books. So how does where's the recession going to come from? Um, how's it going to translate into the real economy? So more than likely, you would see a major hit in manufacturing, given the numbers that we're seeing. You would see these numbers start to turn for manufacturing for sure. Financial services. So you're starting to see Wall Street doing layoffs in areas of their business that are related to mergers, you know, big deal making type things. So you might start to see that. Um, Warehousing, transportation, these are the areas that are getting hit mostly because of China, which isn't opening up as quick as people wish it would. And then probably construction. You would see construction start to come down by a pretty big amount. Leisure and hospitality, I expect to roll over, but much later on into the year because it's so hard to hold on to employees right now that if you fire somebody because business is slow, you might not be able to replace that person if business picks back up. So that's why you're seeing companies fire more like upper management type thing, middle management, but they're not touching the lower employees yet, which is lower on the pay scale because earnings are still positive for most businesses, except tech. Tech's a horrible, just tech's just a disaster right now. Um, Tech has been selling off far more than every other index. If you look at the year-to-date performance, I made this little chart yesterday. This is what mine looks like right now, not including today. But you can kind of see tech's still way down here. So, you know, I think leisure and hospitality is going to be the last thing to go. I don't think this number is going to fall as much as others think it is. It's not going to be an OA type situation where this number just turns that direction. So, but it's going to be a gradual weakening of the job numbers. So, especially in the manufacturing sector, as we go back towards a services economy from the artificially stimulus created goods economy where everybody was able to buy goods all of a sudden. Goods are like washing machines, microwaves, that type of thing. So that's where we're kind of at right now. So I guess we can look at the portfolio. So what did I do to kind of prepare for that? So as I stated before, I'm building up my cash position. You can clearly see cash position has been increasing every video. It's going to continue to increase every video, at least until I think March 1st is when I would be more confident, or at least after the next Fed meeting, which would be in February, is when I would have more confidence because the market will bottom long before, as you can see here, this is the current market that we're in. And as you can kind of see, the trend is down. This is the last bear leg, I believe. And what some are expecting is that this bear market sell-off that's currently going on right now will go through here. But the problem is that it has to get through these different support levels. As you can kind of see, they're marked with arrows here. Boom, boom, and then so you have to get through these different support levels. That's not going to be easy. They're going to try. There's not a lot of volume here. It could be a repeat of December of 2018 where the entire market just dumped off like there was just no tomorrow and there was no buyers, and then everybody showed up. The Fed had to reverse very quickly. Maybe something breaks between now and then you very quickly get through this level down here. Some people are still expecting it to go down to 3,200. And just to remind you, They're all expecting this to happen within the next 3 months. So between now and probably March 15th is when a lot of people are calling for at least a first half or 1H or first half 2023. So it could be up to June. But somewhere between now and June of next year, people are expecting this market to be down at 3,200, which is a pretty significant drop. Um, I think we do retest 3,600 at least. That's where I would start maybe buying. But if I see it start to go towards 3,200, I'm not touching it. I think I'm going to stick pretty firm to my to my March 1st deadline there and just build up cash between now and then. Probably by then I might have maybe 5,000 saved or so. I don't know. Depends how much I make. But on something like DoorDash, for example, there has been a severe slowdown. A severe slowdown. At every single restaurant that I go to, they are empty. Pretty much for most of the day. Um, so that should give you kind of a hint of kind of what's going on here. But that could just be December, where Christmas, presents, Black Friday, people having to pay taxes, state and local taxes, that's a thing. You got to pay those. Um, just various things that uh, people doing charity things so that they can do more deductions for 2023 or 2022 here. So it's just December could just be a really bad month whenever it comes to that type of service. But the restaurants are empty right now, so I think when they get the retail number, which was already negative for the day or for November leading into December, it was right in here somewhere. Oh, this number right here, the retail sales number came in very negative, very, very negative, and that killed this market. It was already going down with the European news talking about going up to 4%, which is just insane. You're not going to have a European Union if they go up to 4%. That's insane. You're going to bankrupt every country over there because they're all running massive deficits, especially a few of them. So I don't think they're going to do that. Um, what could possibly blow up? Maybe Binance blows up. I don't know. I don't know if our market has enough exposure to Bitcoin and all that craziness to make it like, the thing that's like, the Lehman moment. It's just not big enough. So we would have to kind of see. But I mean, the market is, you can clearly see the market is reacting negatively to all the central bank news now. But it's not reacting because of the rates themselves. Normally, if the 10-year was this low, the market would be positive because that means debt is cheaper. Mortgages are actually lower today. So you might actually see mortgage demand actually pick up because of this number right here alone. 30-year mortgage is actually down. But the market is reacting to the data that is coming in, to every single piece of data pointing to a recession. Every single piece of data is pointing to a very bad recession. But the Federal Reserve is talking to, and they're just in la la land. They're just not in reality. Um, so that's what the market is reacting to, as you can kind of see. That's why it's sold off on good CPI news, because it's not good news. It's the CPI data, the inflation data is not going down because it's, just prices are just naturally coming down because there's more supply. It's coming down because there's less demand, which is a recession. So that's when the consumer pulls completely back. So what have I done in that period of time? Just kind of to prepare for this. So I guess this will be my last little thing here. So as I've obviously stated before, I'm in debt paydown mode. So I've paid off largest high yielding debt. Get rid of your high yielding debt as soon as possible, because that's actually affected by the Fed rate. Your cost to borrow on high yield debt goes up. So you definitely want to try and, while you have a job, get rid of that high yield debt if you can. That's what I did. If we are going into some type of recession, I'm not sure what kind of recession it is, and we might come out of it very, very quickly. But high yielding debt. If you're invested in the market, I've decided to just build up a cash pile. I've got my stocks that I want to buy. I did get rid of anything exposed to like local regional banks, so that would be regions. I did get rid of KB Home. So those are two very, very small positions that I had that I just got rid of. So that's what this is right here. That's the difference between these two numbers. So, and then also, like I said, just building up my cash pile. And we will know, I think, by February, because one way or another, CPI is going to come down in a big way by February, I believe. no matter which model you look at, even if inflation goes up, we're still at 5.5%. Even if we get this number to go higher, we still end up at 5.56. I don't think it's going higher. There's no chance. I think we're going to be in the low fours. I think we're going to be maybe mid or low fours by February. You're going to know. Like when they get to that Fed meeting, they're going to clearly see that the trajectory is a straight line down. Now, if we're over here, they're going to see the trajectory is this way, and then they're going to start talking about doing cuts. You start getting into here, you start seeing the numbers go this direction month over month, this type of stuff. This is when you get emergency Federal Reserve meetings, and they start chopping 75 basis points off the top of the thing. So I think 2023 is going to be the year that we talk about deflation a lot more than we talk about inflation. I think inflation is just going to be a word we don't even care about. I, so, but that's definitely where we're at. So, like I said, the portfolio, everything's turned on. Reinvesting. Um, there's nothing really special going on with the portfolio. Everything's kind of doing what it's supposed to do. Everything's got dividend reinvesting going, and all the companies with free cash flow are there. As you can kind of see, all these are the ones that pay out tonight. O is definitely one of my bigger ones, and yeah, I think we're doing. I think we're all right, kind of going into this. And then, like I said, we got this ready to go to buy the dip on some of my favorite names. So let me know what you think. Leave a comment, and I'll be happy to respond. Y'all have a nice day. Thank you.